Hi, I'm Nash from Alpha Crusaders, and I had a really interesting case study I wanted to share that answers a few different questions. This is a late 40s male wanting to start a very large policy, funneling a lot of money through, and stopping around, traditional retirement age of like 65. This is going to be a supplement to real estate investing, place to store money that is safe, liquid, tax-free, as well as, if the client wants to ramp down his investments and stuff in future years, utilizing this as a nice retirement vehicle to take distributions from. But the funding design is essentially $250K for 10 years. That's kind of the base design. But we've optimized and done a little tweaks to optimize the funding that I'll go over in a moment. But what this means, the base design, is that the minimum annual amount for a $250K total allowable funding, you can't go over that because we're setting the MEC limit very close there to optimize the efficiency of the policy. The MEC limit is the modified endowment contract limit, or the IRS limit that would, if we go over that, trigger unfavorable taxable events. So we don't want to do that, but we push right up against that MEC limit, but stay in it. The minimum annual, or that base premium amount, buying you whole life insurance is about 10% of the max funding, so about $25,000. That's really the minimum required to keep this policy going, and you do not have to fund any more than that. The rest is flexible, all the way up to $250,000. It goes into what's called the paid up additions rider, or the cash dump in that comes back to cash value and starts compounding for you, earning you interest and dividends, growing your cash value and death benefit over time. And you can access those through policy loans. So big reason we designed the policies this way is not only the efficiency, but also the flexibility. You can fund, at least with Guardian, anywhere in between those two limits. And if you miss funding or taking advantage of that max space, it rolls over from year to year during your funding period, and you can catch up later. So what we've got here is the maximum is in the annual outlay column. What we've done is actually allow the client the ability to fund even more in year one. You can do this with longer duration policies where the base premium is still around that $25K, but you can actually dump way more money into paid up additions in year one. What this does is take advantage of the MEC space available, and it really just starts that compounding machine, from day one, which boosts up the efficiency, it boosts up the return in terms of how much is coming back and that I can access in my cash value in year one. Generally, we'll see flat designs are 83%. This would boost it up to, I think it's 86, 87%. And then even if we're taking a policy loan, it starts compounding on all of that year over year for every year thereafter. And that's why it can be so powerful, that year one bullist. But the question the client had is, what is the impact of direct recognition treatment on my policy? So first, let's go into what that means. So I'm scrolling down here. This is the available funding, and then the total outlay. So the plan, 15 years, available to fund a maximum of $2.759,756. So $2.76 million, just about. The minimum, again, is 25,000 times 15, and actually it isn't even that, because we can stop funding sooner if we want. But 25,000 times 15 is 375,000. So we could actually stop funding in year 8. So much less than the maximum amount available to him. So what is the impact of direct recognition treatment on my policy? Let's scroll down here. So what this has to do with is taking loans out on your money. And a lot of people hear that, and it is true, even if you have all of the money on policy loan from your policy, it is still growing as if you hadn't touched it. This is, synonymous or relates well to, say, a mortgage on your house. If you get a mortgage, which most everybody does to buy their home, say it's $1 million of home value, you may get a mortgage on $800,000 from the bank. Well, if your home value increases to $1.1 million or $1.2 million, do you share that gain with the bank? You don't. You as the equity owner actually gets all the benefits of that. So it's a similar concept. Even if you have 100% on policy loan, it's as if you hadn't touched it. You're the equity owner in that cash value still, and it's growing it's still growing. And what the details we're getting into with this question is that with fixed loan rate policy loan options, which Guardian's fixed policy loan interest rate on their new products is 5% advertised. If you pay it off on your policy anniversary date, it's actually 4.76%. These fixed loan options actually has what's called direct recognition treatment. So when you take a fixed loan interest option, the policy loan will have a different dividend rate. So your rate of return will be different. What Guardian does is actually decrease the dividend. Currently it's 5.65%. They'll decrease it to match the loan rate. So they'll decrease it to 5%. That's with fixed rate products. They do, however, offer a variable loan rate at the 10th year. And many companies have variable loan rates. Sometimes you can pick them at the very beginning. Sometimes it's an election as you go. Guardian will offer it at the 10th anniversary of your policy. And you have to elect to take it. It's a take it or leave it, basically. If you elect variable for the rest of your policy, you'll have a variable loan option, or you can stay with the fixed loan option. And what they do then is they'll drop it to 3.5% fixed loan interest rate at the later of 20 years or age 65. So this client is late 40s, so say, 49. 20 years or age 65, 20 years plus 49 is 69. Which ones comes later? Age 69 comes later. So at age 69, the rate would drop to 3.5%. That sounds great. However, remember the direct recognition treatment on fixed loans. So your dividend rate would then drop down to 3.5%. So that's a pretty big hit. Normally, the cash values are so large at the later end of the policy that the gross growth is so much, it isn't that much. We're going to look at the numbers, but it is something to be very aware of. So the variable offer moves to indirect recognition treatment, and we're going to show you what that means. It is variable. The floor is 4%, and it's tied to the Moody's Corporate Bond Index. So once you select that, you cannot go back, but it's a really nice option to have. I just took a snapshot from the St. Louis Fed. Basically, this is that Moody's corporate bond. This is the 80s, so when we had really, really high yields on bonds and stuff, and it's just been perpetually coming down ever since. We got down here to less than 2.5. And now it's curving back up. I think it's like 3.76 today, which is May 19th, 2022. So it's been trending down recently with inflation and everything. It's curving back up a little bit. We could see it continue up a little bit, but I don't think this is a major reversal. We'll be this will remain to be seen. But anyways, if you're just starting a policy, you have a lot of time to consider this. The other thing is that with third-party lines of credit, so you can actually use your cash value as collateral to get a line of credit, basically an account that has a line of credit, just like a very, very large credit card, except much more attractive interest rates. And those rates are currently around 3 to 3.5%. And those are also variable, but another way to get around the direct recognition treatment. And we know a lot of these companies and can refer you and help you make the right decision because they have different nuances to them. But this is another way to get a very attractive interest rate and get around the direct recognition treatment if that's something that really concerns you. So let's jump into the numbers. This is that standard policy design, that out of pocket here, $375 in year one. We did that trick where the base policy premium is still much less. It's $25,000, but we can dump in a lot of money into the cash component of the policy. $322,000 comes back to net cash value in year one. That's 86%. If you recall, basically if this was $250,000 instead of $375, it would be about 83% coming back to cash value in year one. And then every year thereafter, even if you take loans, it is compounding with that bolstered cash, which is really attractive. Then dropping down to $250, so your growth here. Breaking even right about year 5, and between year 5 and 6 is when you'll see that going on. This is a very large, one of the larger policies, so $6 million in death benefit, by age 80. We've got $8.3 million in cash value. We've got over $10 million in death benefit. And this column right way over here in column K is the growth in cash value year over year. We have no more out of pocket since year 16, and it's growing by $300,000. So even if the rate drops, the rate drops down here to 3.5%, and you take a direct recognition loan or income, it's still going to be very attractive because we've got so much money in here. You can take those distributions. Some people never pay it back, never pay interest, and it's just growing at such a high rate. You can take distributions, and it really doesn't impact the policy so much. Now, taking a fixed interest rate with direct recognition treatment. So what we've got here is modeling in year 11 a loan of $1 million. Taking $1 million out, I'm a real estate investor, I want $1 million bucks, I'm going to put it into a syndication. Basically I'm a passive investor in a big real estate deal to generate returns. We've got here that effective 5% fixed interest rate. If you pay it on your policy anniversary date, that real rate would be 4.76%. If we don't pay it on our policy anniversary, it compounds at 5%. It's kind of confusing, but you get essentially a little discount if you pay it. But you can see that here, $1 million bucks. What's 4.76% on $1 million bucks? It's $47,619. Seems like a lot. However, we're not going buying a supercar with this $1 million bucks. That's a liability. We're actually putting it into a syndication. So what does a syndication with relatively low cash flow, but more of a capital appreciation play on the exit, on the sale in year 5, generate for you? Well, maybe around 4% cash on cash while we're waiting, and then a large exit. So 4% of $1 million is $40,000 in year 1, year 2, year 3, year 4, and then in year 5, we have return of our $1 million bucks. We have giant appreciation play of 80% from the exit, and we have $40,000 of cash on cash as well, for a total return of $1 million of our original capital, and another $1 million from all the cash flow and exit of that real estate. This is very common that you'll see with syndicators. they're in their underwriting, and actually is not out of the norm of what you'll see in actual performance either. Honestly, this day and age, being an investor myself, we're seeing a lot of exits at year 3 or even sooner with annualized returns being even better than what we're showing here. So seems like big numbers, but this is, as investors, why we're trying to put our money to work in 2 places at once. I also have the policy cash value growth. So year over year, we still took a loan. Our cash value dropped from $2,899,000 down to $2,056,000. Why? We took that $1 million out, but we didn't drop by $1 million because we're still gaining by over 100,000 in year-over-year growth, even though we're getting that direct recognition treatment, a lower dividend treatment. It's still generating definitely positive returns for us. Your death benefit is also collateralized by exactly $1 million, and it is growing, but it is going down by $1 million plus growth. So at the end of this, what do we have? We've taken out $1 million and we've invested it. We've paid $238,000 in policy loan interest on our policy anniversary date, so that it doesn't compound. So we've put that $1 million. We've gotten $1.8 million in returns, plus our $1 million of capital back, and our cash value is still growing at a rapid rate. So taking all the math and taking that $2 million, paying back the $1 million, so now we're down to $1 million, plus $625,000 of cash value growth, minus that $238,000. We have an extra $1.387 million in addition to our cash value restored over here since we paid our loan back. This is the beauty of this concept, and pairing it with real estate is that we can actually kind of have our money working in 2 places at once. However, these next 2 columns just show the difference because of that direct recognition treatment. So you see that $1 million, and then why is it greater than $1 million? Because we're getting a slightly lower dividend rate because of that direct recognition treatment. So you see it 10,000, 22,000, etc. So when all said and done, the loans paid back, we have $62,000 less than we would have if we hadn't touched the money in the first place. Well, what's a nice alternative? The nice alternative is, well, we can elect a variable interest rate option that would have non-direct recognition treatment. Your effective loan rate right now, because the Moody's corporate bond is 3.76, the floor rate is 4% advertised. If you pay it on your policy anniversary date, you would get 3.85%. So same situation, $1 million out. What is 3.85% of $1 million? It's $38,000. This is kind of nice because our cash on cash returns from that same exact syndication is paying us 4%. So it's actually yielding us an additional $1,500 or whatever. So we're covering with the cash on cash that policy loan interest plus a little money to reinvest or whatever. Same thing, getting the money back out. But if you look here, we have more money. The reason is that policy loan interest currently is a little bit less. The cash value growth, sorry for this is that cash value growth in the direct recognition treatment situation. So $625,000 as opposed to $685,000 because it's still getting that higher dividend rate. It isn't recognizing that we took a policy loan, which gives us even more money working in 2 places at once. $1.493 million. Now, what happens to our cash value and our death benefit because we're taking these loans? Nothing. it just reduces by exactly $1 million in the cash value. It reduces by exactly $1 million in the death benefit. And as soon as we pay it back, it is exactly restored to the value as if we hadn't touched it in the first place, because it's been growing as if we had never touched it in the first place. So let me hide this middle scenario. We can prove side by side that it is exactly the same numbers. So on the left here, we have the scenario as if we hadn't, we just are putting in money and letting it sit and grow. And on the right, we have that loan, that $1 million loan, and repaying it. So let's just take year 17 here. On the left, didn't even touch the money. It just sat in the policy forever. And we, 4.157 million in cash value. What do you know? Exactly the same number and exactly the same death benefit. So this is really the beauty of high cash value life insurance, something to be aware of with direct and indirect recognition treatment, and some really great options for you. So let me know if you have any questions. Visit my YouTube channel. We're going to be releasing a lot more content, answering these questions, going through these case studies, and yeah, I'll talk to you soon. Thanks.